Hey, good morning. It's Tuesday. I thought we should look at the stock markets today. I'm seeing on social media a lot of chatter about stock markets are overvalued. They should crash or at least have a significant move to the downside. And yesterday I saw something on Twitter about hedge funds increasing their short positions in US stock markets. So let's have a look and see if I can find a reason why we should sell the US stock markets. I've got the German market up there, actually. I want to look at that last. So this is the US 30, the Dow Jones. That's 5 months of data. We've been in a nice steady uptrend since that collapse, which was triggered by the tariffs. Good recovery. So all looking good as far as I'm concerned. Yes, we're entering a consolidation phase. We have been there since the 22nd of August, since that big move up. So we're talking about a 2-week consolidation. But there's nothing here on the daily chart that indicates to me the markets are about to have a significant fall. We don't even have a negative candle, let alone a negative pattern or a negative trend. So really on the daily chart, nothing to indicate the US stock markets are about to have a significant fall. We'll just have a look at the 4-hour chart just so we get some intraday data. Okay, we've got a bit of a negative candle here, certainly a bearish engulfing candle, but we had no follow through from there. We hit the trend line and we've bounced off it. So buyers are still prepared to come in at decent support levels in the Dow Jones. You can see that trend line going back to the 1st of August. So it's about 6 weeks old, 5 weeks old, and it is holding the 50-day moving average. We haven't come anywhere near it since the 1st of August. My assessment for the US 30, for the Dow Jones, is it still looks positive. I don't see any reason to sell it. If we were to break this trend line around 45,300, I might change my view, but for now we're 300 points above. Moving on to the Nasdaq 100 tech heavy index. Since April, since the tariff correction, we've had a good run up. If the Nasdaq was going to collapse, you might have thought it would do so having broken the trend line going back to the 30th of April. That was on the 1st of August. We broke below it with 2 significant red candles, but immediately we got a big green candle and the market rallied to a new all-time high. Since then, we've had more sideways action. I've got a slightly descending trend line and an ascending trend line. So I'm going to call it a triangle pattern. The trend lines are not really converging very quickly, but I can call this a consolidation pattern. We're holding the 50-day moving average, the white line. There is no reversal pattern here, no double top, no negative candles within that consolidation pattern. So for me, it's sideways, and eventually the likelihood is that we will break up and resume that longer term bull trend. Let's look at the 4-hour chart in case there's something I'm missing. Okay, just like the Dow Jones, we did have this bearish engulfing candle on the 5th of September. That must have been the release of the non-farm payroll number. That was when we had the big down move, when job numbers only increased by 25,000 when I think 75,000 was expected. But we've recovered since then. Yes, we are holding that upper trend line, which is more visible on the 4-hour chart. But again, just nothing to indicate that there is a significant move to the downside. We're up the upper end of the range, so chances are we will break higher, not lower. Finishing on the US markets, this is the S&P 500 again from the tariff correction. Really strong run up, probably the strongest run up of all the markets, in fact. So the S&P's looking really good. We've got, I'm going to call this, well, look, I'm going to zoom in on the 4-hour chart. We've been in a nice uptrend. I put a second set of Fibonacci levels on there. We've been holding the 23.6% there. Every time we've dipped, we've seen a strong recovery. Really no candles on the daily chart there to indicate to me that there's any serious problem for the bulls. Let's look at the 4-hour chart. I'm isolating this pattern defined by upward sloping trend lines. This is the most positive pattern of all three at the moment. On the 4-hour chart, I've got a second trend line joining that non-farm payroll dip on Friday. Strong recovery, made a new all-time high yesterday. In fact, 65.31. Actually, that was the 5th of September. That was Friday's high. We moved up swiftly on the release of that non-farm payroll number. I think the market was reacting to the likelihood of lower interest rates and sold off, but recovering. Higher highs, higher lows. Investors are still coming in and buying the dips. I see no immediate reason why the stock market is going to have any significant move to the downside. Let's just have a quick look at the European markets, the UK 100. 4-hour chart. Let me go to the daily chart. We need a wider perspective and then zoom in again. Okay, let's see how to move to the downside as well in April on the tariffs. But again, another strong recovery. similar to the US markets. We've had a bit of a down move recently, triggered by the gilt market auction last week. You can see we dipped to the 38.2% Fibonacci level. I've just started from that little low point here, just before the latest run up. That was from the 26th of June, if you want to put Fibonacci levels on your chart. The 38.2% caught it perfectly. We've got these long lower wicks on the candles on the daily chart here. So that really indicates that there was some strong buying interest at that 38.2% fib, just above the 50-day moving average and just above my trend line, which I have there going back to the 23rd of April. Buyers are coming in at the support levels, pushing the market back up. And if we can hold above 9,200 in the FTSE, things look good. We would have to be breaking below 9,100 before I started to get a little bit nervous. And even then, I would only be looking for a short-term correction, probably to the 89.50 area, where I would be looking to buy in again. There's nothing, as I say, to indicate that we're going to have any big moves to the downside. If I wanted to be negative, I could argue that there is a potential head and shoulders pattern. Potential because it certainly hasn't played out yet. There's no confirmation, but I could join this low to this low and argue that there is a possible left shoulder head, right shoulder here if we don't make any further gains. And if we decline, then I could argue that that might be a small head and shoulders pattern. We would have to break 91.20 on the downside for that to trigger. But even if that did trigger, we would only be looking at probably 89.50 as a downside target. It would be a short-term move, and I would be interested in long positions around 89.50, 89.30 in the FTSE. Okay, let's have a look at the Germany 40. I think I'm going to have to go to the daily chart for that. Let's get a wider perspective and zoom out. More of a sideways trend than an upward trend in the Germany 40. The DAX is probably the weakest of the markets I've looked at this morning. I would be more concerned about a break to the downside in this market. Let me put some Fibonacci levels on. If we started breaking below 23,000, then this market might be in trouble. For now, it's in a sideways consolidation, not as strong a trend as the other stock markets, but it certainly isn't telling me that I should be worried about a collapse. Could I call this a head and shoulders pattern? Left shoulder, head, right shoulder? Yeah, I guess I could actually. So if we break 23,000, it could drop to 22.5. We could hit that 38.2% fib. That would be about as far as I could expect to move to the downside in the German market. And as I said, that is the weakest looking market, and even there I'm not expecting a crash. I hope you found that useful. Join me again tomorrow and I'll see what I can find for us on Wednesday.